There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Markets have been selling off. No surprise, right? I've been talking about this for 6 months. This is that we're looking at the NASDAQ here. These are weekly charts, by the way. Let me just expand so we can see it better. One more. Okay, cool. All right, S&P, no surprise. Just to see, for those of you trading, I know we've got a fair amount of traders out there trading different type of indice-based stuff on their MT4 platform, either actively or accepting trade notifications. Either way, I still think regardless of whether you are in or not in that arena, got to be paying attention to what's going on in at least the big cap portions of the global markets, right? So what does that mean? That means things like the S&P, things like the NASDAQ. Don't pay attention to Dow. It's a waste of time. It's an inefficient benchmark. The UK 100, okay, which essentially is the FTSE 100 index here. The DAX, right, representation of the European version of the S&P, and then more expanded look at the stock 600, okay? So we're looking at weekly charts. I think it sort of tells a better story. Obviously, you can see the pandemic selling off on all these charts I'm going to show you. But even though we've come back down to pretty decent support levels, certainly with we haven't really retraced that much, right? And look how quickly we retraced this towards the last scare of, this is mostly pandemic related sell-off in my opinion, lockdowns, all that stuff due to the Omna crap. But in addition to this, it's based on probably a whole new set of stuff. And a lot of that has to do with central banks taking liquidity out of the marketplace in various forms. So, because I think this is such an important point, and as I often joke, many of my clients may be wealthy, but in terms of financial prowess in the markets, they have the education of a fifth grader, right? So I always try and put everything in terms people can understand. And the way I've been explaining it to clients and prospective clients and subscribers and all the employees and our agents and our advisors and all that stuff is going to be the following. Picture a circle with 10 children in it. And the circle has, it doesn't really matter where they're sitting, but just picture a circle of 10 children sitting Indian style. They have a lap full of apples, right? The center of the circle is the marketplace. So if a child wants to sell an apple, they could drop it down into the marketplace and bid out and go through price discovery and negotiation and figure out a market price for that apple, right? The opposite of that is, well, actually, let me back up. Easier if I bring it from this perspective. Quantitative easing, okay, is essentially those children taking all the apples off the center of the circle and putting them in their laps and dropping cash back down into the circle, okay? That's kind of what's happened for damn near 12 years. We're starting to get a hint or a whiff that the opposite is going to be taking place. So the question now is, do all the children stick all their apples up for sale all at once and then there's absolutely no buyers because there's way too many sellers? So what happens, right? You have a drying up of liquidity. Basically means you have a drying up of buyers. If everybody's selling and there's no buyers, liquidity gets pulled from any marketplace. I don't care which one it is, right? So what happens? We have price discovery lower. We're starting to see that in a lot of stuff, different commodities, certainly the markets in an equity perspective, certainly the bond market, right? Yes, they can get down in tandem, right? We're seeing yields go up as prices of bonds go down. We'll touch on that briefly, but that's the best way I can kind of explain. I think it's oversimplified. I think it's missing a couple of key points, right? But just in terms of simplification, right? The question really now in fifth grade terms is how many apples are going to be put in that circle? I don't have that answer. I have an idea, right? But I could be wrong. So when you're coming up with all these sorts of things to look at, and we're actually have a a podcast coming up we're going to shoot, and I think a lot of the podcast really needs to be centered around just a macro discussion, because everybody's climbing into the weeds with too many reasons. There's too many talking heads out there, and I don't think people understand or grasp the sort of biggest picture there can be, right? I always like to envision it like you're in the space shuttle and you're looking down on planet Earth. You kind of see everything as one shot generally. That's kind of how I think the bare minimum everybody should be educated on the financial system from the standpoint of central banks. So let's take a look at the indexes. There's DAX, big support, bounced off it, at least from a weekly perspective. Okay, daily, do a reset here. I mean, we're right there. Let's sort of see all this. UK 100, a little bit better shape. Certainly speaks a little bit to the strength we've seen in GBP. Although if I jump to GBP, you can see it's gone down in last 1, 2, 3, 4, 5, 6. We're on the 6th day of the decline under you know a pretty decent rally, and that's obviously because the dollar's rallying, right? So look at the S&P. You can look at the spiders, the S&P, whatever. You can look at the NASDAQ or the Qs. This gives you a general representation, right? Seems like a big old correction, right? Then I switched to a weekly chart. So in the grand scheme of things, this looks like, most people, watch my charts like, oh, hey, that's 2008. Now, there's 2008. So you can see how far we have come just in tech stocks since then. Is this a blow off top? Is it a shooting star? Is it some sort of crescendo pattern? Right? I don't know. Ideally, the market's job in any place, including Forex, is to fool the most people most of the time. And it's to completely catch everybody off flat foot and pull the rug out from underneath them at the least expected time, like right now. How many times have we seen? Now, obviously, the Fed's been more of a in and out there, open market, protect the stock market type operations. Many central banks and developed markets have. We're not seeing that right now. So the question is the Fed willing to let the equity market stand on its own 2 feet without any kind of intervention? And that is a huge question right now, and I don't know the answer to it. Don't know that I ever will. But at least understanding what's going on as far as broad markets is key. So we got lots of stuff going on. I wouldn't worry about all that. The point is we're holding support for now. We're on the edge though. So, and if we go to the weekly chart in the S&P, you can see where the support is from that perspective. If we just care from actually, you know what? I'm gonna just do daily. From a daily perspective, and if we only care about this whole range, when did we hit it here? I think that's fairly representative, right? This is sort of our launch out of a solid base pattern point. Yeah, you can kind of see here we had a cup with handle breakout, came back down and tested it again. It held. So that 42.30 area, which was a sort of like a flash crash yesterday, we bounced off. I mean, these support points are being defended for a reason, right? I think a lot of institutions, as the window dressing gets played, kind of like the old days in the department store windows, sort of dress them up for the holidays, make everything look great, just let the markets drift up in the end of the year so everybody can big bonuses, and then we'll figure it out after the first of the year, right? So it's kind of what you're seeing take place. We're not heavy in equities and client accounts, even in our youngest and most aggressive clients, even some of our wealthiest. Many of them thought it was a bad move, but now we're getting tons of calls from everybody going, holy hell, how'd you guys know? It wasn't about us, and it was just about reading the tea leaves here. We think this could get a lot worse, but I would expect some other rug pull move to cause the most pain. So, where would be the most pain at this point? Probably a big fat rally. So, advice to the masses: if you have short-term time frames on your money and you're playing this game, we rally back some point this year. Who knows? I could be dead wrong on this, but typically this is what's taken place um, the last 12 years. We rally back to a new high on lighter volume. Maybe it's an opportunity to lighten up on equities. Maybe we'll rally up to a higher point. I probably would be, especially if the Fed has signaled at some point they're going to significantly increase open market operations, start putting more apples back in that circle. I wouldn't want to be heavy in equities. If you're, 20 years old and you got a bazillion years in front of you and you want to keep holding Tesla and buying more, hey, have at it. Just don't say I didn't warn you when the stock gets cut in half. Okay. It's all about risk. For the questions I get, we don't have any client, I don't care how wealthy they are, with any more than about 2.5 to 3% in any one stock ever. All right. That's of their portfolio of what we're managing. So, with that being said, let me shut up on the equity markets and move to the bond market. Longer term is probably best represented by a weekly chart. So 7 to 10 year, near in the bottom. This kind of stinks for those looking for mortgage rates because they're going up, right? Prices of bonds going down, yields going up, interest rates going up because the prices are falling. Same thing. We're holding pretty steady on the longer term stuff, which is TLT right here. This is one of the more liquid ETFs in the whole world. Trades millions and millions of shares every day. Moving into the DXY and currency land. um, not much different than what I mentioned on Saturday, which I did understand they were having some issues with the recording and all that. So whatever. Do note that I am going to be moving, so I hope to be able to pull off an OBS broadcast on Saturday and Tuesday, of which I'll be in an empty house. And on Tuesday, I'll actually be driving across the country. God save us from willing to kill each other after 4 days of driving together. My family is awesome. I love them, but it's going to be an issue. So please bear with me as we get all set up. I'm actually going to have a whole studio and a whole podcast area in our brand new office in Florida. And we'll be able to do all kinds of fun stuff on camera again. But suffer for the next 2 weeks, please. Euro USD. Lots of really small from a weekly perspective, just hovering around this area. Now, I don't see any catalyst. Who knows? I could be looking through Coke bottle glasses, but I don't really see any catalyst that's going to get us to break out of this area. GBP we just looked at again, but I wanted to show a daily chart. The trend has reversed. Trend down for now. Trend sideways. I just call that a balancing. Price is discovering itself between two fairly defined ranges. US CAD. Rallying the dollar. Although got the high on the dollar right at 9, just under 97. Actually, let me go back weekly. So we know the launch took place. Keep in mind these are weekly charts. Probably a little easier to see this. This was our breakout point right here. This whole 94.50 I shared. I've talked a lot about this in previous recordings. the rip that ensued off of this was really nothing more than a fairly complex of short barbecuing, as we like to call it, where there was a max pain was up, right? So market has a tendency to always want to go max pain. That's why, as a trader, one of my advice has always been to students, um, don't be that sitting duck on the perch waiting to get shot off by all the market makers, right? Well, I got to put stops on my stocks, and yes, you do, but you already know, at least I hope, if you haven't or you don't, and maybe you're new, that's fine. You will learn listening to me. But if you're seasoned, you don't necessarily need a stop out there as a sitting duck, especially in equity land, because they have a tendency to go take all the stops out, right, and then completely reverse. It's happened just time and time again. So you have to wait till see how the market reacts when it gets to that point, right? Like yesterday's buyers down at that 4230 area in S&P. They're a pretty happy bunch today, right? It's typically the big traders, hedge funds, and probably a few lucky retail folks that caught that. Now they're riding it up. Hats off to them, man. I love this stuff. Volatility is actually a really cool thing. It scares a lot of people, but it wakes you up from those sleepy days of the summer where you're staring at screens and nothing's happening. You should probably just be on the beach or a golf course or on a boat. Three things I'm totally looking forward to in Florida because as much as everybody thinks it's so awesome out here in SoCal, the water's freaking freezing and it's always cloudy at the beach in San Diego. Stinks. So, Steve, are you happy to be moving to Florida? Yes, I am, but I'm not looking forward to the humidity. I have to deal with that. In any case, I think I've said enough on this. Let's check the next. There's CAD on the daily chart. Big support area at this 2470-ish area. Yen still balancing in a tight upper range, which doesn't look like it's defined by red bars, obviously, but you can see the range. Very, very, very tight range for some period of time. Nothing crazy out there. Euro GBP. I'll often get asked to show this. Really the big area we broke under is this whole 85.13-ish area. I think at some point the going to back up and test it. I thought we were headed up there here, but the pound's been selling off over recent. I don't really have anything to say here. Euro CAD, tight range still. Euro Aussie, tight range. GBP CAD, our neo currency, still in a defined range. You'd think that this area would have held, but the pound's selling off, right? So it pushed down through. This was the max pain trade right here, right? You'd expect it to support right around the 7,100 area, right? But it broke through it. By the way, you notice it came on a little higher volume than average. So some were feeling pain. That's that max pain trade. I always try to be on the coattails of this, not fighting against it, as I'd rather be on the back of the train pulling out or flying through the train station than I would standing in front of it trying to catch it. Does that make sense? That's that whole falling knife concept, trading with the trend, if you will. Let's see what else. surprisingly enough, from a daily perspective, we haven't seen more of a pullback in oil, you know, and finally, it's like it seems like I've been talking about this for eons, right? Gold's up against its resistance high. We're at it. So maybe finally the gold bugs can have their day in the spotlight as we rip above this area. I imagine there is some big institutions sitting on some pockets of buy stops when this breaks out because it hasn't done in a long time. Everybody thought it was like the big breakout and we were going to run to 2,500 here. I think, we're coming up on a year since that high. This has really befuddled a lot of the gold bugs, right? And the liquidity trade, may continue to really truly help this breakout, and maybe we do finally see a rise into that 2,500 level. Seems like it's never going to arrive. Let's take a look at this mint fund here for a second. Not paid enough attention. Now, VIX, as you can see here, it says the volatility S&P 500's VIX, measure of volatilities. So in a while, quite a while, we had spikes. And notice how big that spike was yesterday. So, and I think these are all. One thing I hate about TradingView is I like how I used to being on my other systems, just right click and scrub data. It'll go through and scrub all the data and try and find all the errors and whatever data came in from whatever the data feed is. You can't do that here. Wish you could. It seems like we got some bad data making these lines go crazy here. Because if these lines were true, these would be Armageddon readings. See how it's throwing everything off in the chart? Let me just reset. In any case, do note that when you have high levels of volatility, the VIX index spikes up. You really want to be concerned when the VIX is up around these pandemic levels. I mean, this is what's called a fear and greed index. A lot of people use different terms to associate with that. This is my fear and greed index, right? When you get up at these levels, it's bananas. It's also fun but it's very dangerous from a price movement. Things can move a lot farther and faster than you can stay solvent. So just remember that. If I've taught you nothing from a risk management standpoint, just like when I was on stage in Orlando for our big event, the market is really goal is to bankrupt everybody, right? Now that sounds terrible, right? Now, how can the market want to do that? Well, the marketplace is all known information priced in, right? Generally. If there is unknown information that emerges that's not already priced into the market, it creates volatility, and this is measured by the VIX. That's why we see current levels, and I guess maybe I should take a look at it on the weekly chart. So maybe this puts it more in perspective. So the line of demarcation, as I'll call it, where there are no aliens. We do get notification there are aliens among us, right? And then things go bananas. I call it that line of craziness. It's somewhere around 45. But from a resistance standpoint, it's 39. So just keep that in mind. If we get above that, we want to scale back trade size usually. Okay, why am I looking at Tesla? All right, so I did want to talk about the coinage because I would have expected, as we talked about how this just didn't look good. A lot of I noticed I noticed how quiet Twitter is in the crypto space. It's crazy. It's almost like everybody that was a shill died on Twitter. Nobody's talking about it. It's great. Why? Because they probably in many cases gotten their asses handed to them buying at 68,000, and they didn't have the guts to hold through this. They probably bailed and thought I'm out of it forever. There's horror stories all over the place. But notice on each time we come down, hold up position, there's barely any rally back, right? Now, if we had some big rip up, not like a huge move, but it had been followed by an increase in volume, maybe there'd be some girth to the rally. Then you want to see a nice base build and trade the breakouts, right? But in this particular case, it was almost like Dojiville till the next dump, right? And that could be the case here. Before this big induced rally, which was just a mania, right? Kind of like the media is trying to do to your brain with COVID. And then the rip that's ensued here, it wasn't followed by a lot of volume. Yeah, there was some pretty up good days, and it's everybody just chasing performance. I mean, where's the buying now? Notice there's been much bigger volumes of late. Why? Because we broke some key levels. So I think this just forced liquidations bringing in some. I don't think this is buying. Hey, for anybody that's long with a big position much higher, for your aspect, I hope I'm wrong. But when those apples get pulled out of the circle of children, the apples that get pulled first are the ugly apples that are all rotten and nobody wants them, and they get thrown out first. So, love or hate that story, you can call me the biggest jerk ever. It's typically what I see from the perspective of crypto. But what I would like to see from everybody's perspective is us get back to this 20,000 line. This is max pain trade, by the way, right? I'm going all the way back. I like to be able to see all the sort of inversions of this chart, but you can always drop it on a weekly and then expand it out, right? We broke here a little more than a year ago, and I'm pretty sure this is going to be our coming to Jesus line again. What we do at this line is critical because a lot of people say, "Oh, all right, we hit 20,000, I'll just buy it." Nope. Got to see what it does. Ideally, you want it to trend sideways, form a reputable breakout pattern. There's a bunch of them, cup with handle, there's all kinds. Form a reputable pattern, and then volume starts to participate in as it breaks, then you buy. Don't put all your money in it. It's just like any trade. Use risk management. There's all kinds of Kelly criterion I've put out there that allow you to size trade risk based on net worth and liquid assets that you don't need for a longer period of time. But that's ideally what I'd like to see in crypto land. Is I actually have a big AP call today with a couple offshore experts and attorneys and so forth. So some stuff we're looking to do, which is pretty cool. But got to tell you, I actually let me just double check this one question I just got. I can send that to you, or I could just post it on the Telegram channel. That's fine. There we go. Let's see if I can find this now. Okay, I'm actually going to bring this into the screen. It's like I wish there was like some room I could post. I probably should just forward this to my channel, right? You guys need to take a close look at this Panther. This very well could be our best EA. I watched it on the plane, and it was pretty good. I can't. I haven't torn through all of those quant strats statistics. I was going to get the printouts and the stuff um, from Dom. He's our developer over in Croatia, and it looks really good. Got to tell you, they run a whole bunch of quant analyzer stuff on. They've run it on real money for 2 years, so it has a lot more testing and backing of real dough, including some big accounts. So I would say, for anybody, and I know there's a bunch of people out there that fit this description. they were previous subscribers to AP for one reason or another. Maybe they came in and just blew up accounts, which happened to a chunk because of the fact they didn't learn. They thought you could just put money in an account and you'll make money and do nothing. That never happens. I don't care how good the tip is. So I've heard that there's been stories that have been printed. Hell, they've made movies about this where they could actually tell you exactly where to buy, and 80% of the people screw the trade up. So there's a lot more to learning. Obviously, I try to teach the macro risk management standpoint with some charts thrown in for fun or for color, but it still goes without saying that this could be the product that brings all of those subscribers back to Auvoria. And if in fact you feel the same way, get out there with the bullhorn and tell them. So that is the weekly call. I am Steve Vetterl. Hopefully I will be right on everything I've said and not look like a complete idiot. But we could always be wrong. And that's what I spend most of my time trying to figure out, whether I will be right or wrong. But you spend a lot of time with a prognostication and then double that amount of time figuring out how often you're going to be wrong in relation to that, you're going to be much more prepared for what to do when you're wrong. So everybody have a great week. Hopefully I don't die with a moving truck falling on top of me. Today's the 25th of January. I am Kevin James, signing off.
There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.